Hey guys, what up? Okay, in this video I want to talk about some tips and points. The first of them is about stop, how to determine your stop loss. I already talked about stop and stop loss and things like that, but it doesn't hurt if we add to our knowledge and talk more about it. Okay, we can determine your stop based on a lot of things. For example, if it's a bear trend, let me find a bear trend. If it's a bear trend, you can enter the position after pullback. I don't know, for example, I want to find a good bear trend. That's a bad one. Yeah, let's say here. No, let's say here. That's your signal bar, that's your entry bar. And if you wanna enter this position and take this one, you can just leave your stop loss above the tail of signal bar, which is this one. But in this case, your entry bar is has a bigger tail, so has a longer tail here. You can just leave it above this tail, or if there is a leg, you can leave it above the leg. Let me put it this way, which is in most cases above this leg, this current leg. It's equal, it's the same with the above the signal bar. Doesn't, there's no difference. Above the leg is the same with above the signal bar, whatever. If you enter the position, let's say here, not after pullback, not after anything, you enter the position here, you put your stop above this recent pullback, above this above this current leg. We consider all of this as a bear leg, so you can just leave your stop here, and you do it until your stop hits. How's that? Okay, I want to show you. Let's check out the bull trend. Okay. In a bull trend, we basically take buy positions. So, okay, if you enter the position at this bar, it's you probably wanna put your stop loss below this signal bar, below this tail here. Or you can put it below the entry bar, which is here, but it's actually gives you a tight stop, which means it reduces the probability. It's not a good idea, I think. It's better if you put it below this signal bar, maybe. And yeah, you're at this position. Let's say it didn't hit your target. Yes, it did. It hit your target here. But let's say you enter the position, but this time not only it doesn't hit your target, but also it hits your stop loss. What a mess. Okay, that's your signal bar, and I'm sorry, that's this one, this white. Is both signal bar and entry bar. Okay, you enter the position at this price, let's say at the close of this candle, and you leave your take profit here, and that's not a good risk to reward ratio, by the way, but it's a practice. Let's say for practice consider this risk to reward ratio, and it doesn't hit your target, it hits your stop loss and you stop out. That's it. You have another option. You can leave your stop loss below this recent leg, previous leg. That's not a bad idea if you do so. But even though, even in this case, even with this stop, you still stop out the position because we have this breakout. We have this strong breakout. And when we see a breakout, there's two possibilities. First, it might evolve into a trading range, which is the happens most cases, and another possibility is a trend reversal. Here we have this breakout and we have this trading range, and after that another breakout. So you might say, okay, my stop hit, what should I do? Nothing. It's a essence of trading, you know. Get this leg, you get this one, you get, I don't know, this one, and one of them, and you lose a few trades. You know, it's not a big deal as long as you have a good risk to reward ratio and winning rate. That's okay, and that's totally normal if you stop out. But for swing traders, that was for scalpers. They enter the position after each pullback and they exit the position before each pullback. But for swing traders who, let's say, they buy at this price and they put their stop below this shit, and considering this price as target, they constantly raise their stop if it's here at the first, and as price goes up they change the stop and they raise it, they move it higher, and by doing this they actually reduce their risk. And some traders they actually make it risk free, which means they trade their stop loss and they put it at the entry price, which is here. That's the entry price. That's the motherfucker entry price. See. Okay. So after each strong breakout, they trade their stop. Let me show you another example here. Yeah. After each pullback, we have this breakout above this previous high. See, that's a high, and we have this pullback. We have this breakout above this level. So, in order to make and create another high, another top, and when this happens, traders, those who wanna reduce their risk, they actually transfer and trade their stop to a higher level, which in this case is this level, below this bottom, which is the previous leg, and this is the current leg here. And after that, we have another pullback here, and then we have a breakout above this level, above this above this previous top. We can move the stop loss again to a higher level, to a higher low, and we continue this shit until price get us out, you see, you put your stop at this level and you take position, and you take profit, for example here. Let me show you. You enter position and you put your stop loss here, and you consider it, take profit, put your target at this price, at this previous top, but it doesn't go up. You see a breakout below this trend line and just stop you out. You stop out and you fucked up. Doesn't matter, because you got all of this, not all of this, but a lot of legs here, and don't be greedy about it. It happens. One of them is just breakout, and you might it will hit your stop. That's how it works. But we have other options to determine your stop loss. Yeah, so far we talked about, I told you that you can put your stop beyond your current leg or your signal bar. Both are the same in most cases, or above the entry bar, whatever. But we can also use other stops, like money stop or price action stop. Price action stop is the we talked about it. That's the signal bar. There's a level here. For example, you consider a level here, and you put your stop below this level. Or if it's a trading range, if there is a trading range, there used to be a resistance, and now we have this breakout above this resistance. You can put your stop below this level. For example, if you open a position, take a position, you put your stop below this resistance, and you enter a position at this price, and let's say you take profit as as high as this trading range height. That's it. We have another stop, we call it money stop. You use this ruler here, and you measure the distance. For example, if you enter the position here, you say, okay, I wanna risk 10 pips or 20 pips or 10 points, whatever. Yeah, as I said, you enter the position here and you say, okay, I wanna risk 10 pips or 20 pips here, and I wanna put my stop above this level, which is 20 pips. The distance between this entry point and your stop is 20 pips. And take a short position, a little bit here. Here is 20 pips, and you take profit. I don't know, 2x, twice your risk. They usually say, okay, your reward is better to be twice your risk, or at least as much as your risk. Both are okay. Both are okay based on your strategy. You take profit here. So that's the money target you can consider. And if there is a long breakout, if there is a long bar like this one, your stop would be so big. If you put your stop at this, above this, and you enter the position, I don't know, here, your stop would be large and you have to take profit. And if you want to take profit twice your risk is here, which it's not that probable. Its probability is not that high. You risk a lot. It's a 50 pips. You can consider the middle of this candle and put your stop above the middle of the candle. See, this is the middle of the candle, and you can put your stop above the middle of the candle. Here. And that's your take profit. It's better than this one. Just put it here. If you look at this candle in lower time frames, you can see there's probably a pullback and some knot in the middle of this candle. So yes, we can consider other options. We can consider other stops like measuring movement. You measure this leg and you consider the second leg, the distance as high as and as large as this leg above this entry bar, whatever, and you put your stop above at this measuring area. Yeah, it's not that hard. Imagine if the price wanted to go up, your second leg would be something like this, but this area you can use it as a stop area and put your stop above this and take profit, like here at this point. It's not a bad idea. You can use it too. We call this measuring a stop. We have another option. We use this tool. We call it ATR. You measure this indicator. It's a good one. it's a real shit. Sorry. Yeah, it's a good useful indicator. We already opened this shit. For example, you wanna consider a stop for this one, and you're curious and you wanna know where should you put your stop. If you see this, if you see here, we have this number bottom at the left of the screen. This ATR tab. It's 3097. If you may consider this 3097. Your stop would be here. Your stop is ATR size. If you enter the position here, you put your stop above this shit, and you'll take profit. Yeah. You can consider two times the stop loss. If it's your stop loss, you can consider 2 times of the ATR. Here is 50, so 2 times of this amount is 30. You can put your stop at this level. Basically, we have 2 kinds of stops. First one is a wide stop, and we have this small stop. We use a small stop for scalp because in a scalp time is money, and we don't want to wait for this position to retrieve, even if there's a pullback. If a pullback happens, we prefer to get out of the position because time is money and we don't have that much time. But in swing trading, we can consider a wide stop because we have time and we can wait. For example, let me give you an example here. Let me give you an example. For example, you enter the position at this price and you put your stop above this candle. This is a small risk, small stop, and after this, when this pullback happens, you stop out the position. But if you put your stop above this breakout candle, you won't stop out. You're in the position still, you're in the position, and you eventually take profit. But look at this. This amount of time, is it worth it? As a scalper, if you ask a scalper, he would tell you that okay, time is money and I don't want to waste this much time. I consider a small stop, and even if there's a pullback, I don't care. I want to get out the position and I will go for another position. But a swing trader says no, I consider a wide stop because I'm patient and I don't care. I wanna just take profit. I don't wanna stop out. So we have wide stop and small stop. We also have actual risk and initial risk. I don't know if I talk about it or not, but actual risk is the latest one, and initial risk is the first one. What does it mean? When you enter the position at this point, you put your stop above this, below this bottom, and as price goes up, as a swing trader, you trade your stop to a higher bottom, and you continue this until you until you take profit. This dynamic stop, we call it actual risk, but this first one is the initial. Some traders, they don't change it, they just consider it initial risk and they don't trade it. But if you trade your stop loss, we call it actual risk, and this one is the initial one. And we usually consider target as large as your initial or actual risk. For example, if this is your, if you want to consider this candle as your stop, you should consider a target twice larger than your risk, which would be here. At this level, you can take profit. Or another one, if you enter the position, take this position here and put your stop below this tail. You want to take profit at this level, because it's twice the reward is twice your risk. Okay, that's all you need to know about stops, and I hope you enjoyed this video. Take care.